Hello and welcome again. This is your host Harshit Simha with new topic on integrated reporting. In this session, we begin our exploration of the integrated reporting international framework, part 1, a globally recognized framework that seeks to transform the way organizations communicate value creation. The framework, originally developed by the International Integrated Reporting Council, IIRC, and subsequently adopted by the IFRS Foundation, represents a significant advancement in corporate reporting by integrating financial and non-financial information into a single coherent narrative. The primary topic of this slide is IFRS Foundation Stewardship of Integrated Reporting. As highlighted, the IFRS Foundation assumed responsibility for the integrated reporting framework in August 2022. This transfer demonstrates the growing importance of integrated reporting within the broader landscape of global corporate disclosure and sustainability reporting. The collaboration between the International Accounting Standards Board, IASB, and the International Sustainability Standards Board, ISSB, further reinforces the integration of financial and sustainability-related information. A key subtopic is global adoption and standardization. The IFRS Foundation actively encourages organizations worldwide to adopt the framework, thereby supporting consistency, comparability, and transparency across reporting practices. Through alignment with global standard-setting initiatives, integrated reporting continues to gain relevance among investors, regulators, and other stakeholders. Another important subtopic is value creation communication. The framework provides organizations with a structured approach to explain how strategy, governance, performance, and future prospects contribute to value creation over different time horizons. As we proceed through this module, participants should view integrated reporting not merely as a reporting exercise but as a strategic management tool that promotes integrated thinking, better decision-making, stakeholder trust, and sustainable value creation. Slide 2. Historical background, the IIRC. This slide provides the historical background of the International Integrated Reporting Council, IIRC, the organization responsible for developing the original integrated reporting framework. Understanding this history is important because it explains the rationale behind the emergence of integrated reporting as a global reporting innovation. The principal topic is the International Integrated Reporting Council, IIRC. The IIRC was a global coalition comprising regulators, investors, companies, standard setters, accounting professionals, academics, and non-governmental organizations. These diverse stakeholders shared a common belief that corporate reporting needed to evolve beyond traditional financial statements to better communicate organizational value creation. A key subtopic is the evolution of corporate reporting. Traditional reporting focused heavily on financial performance, often overlooking critical factors such as governance quality, stakeholder relationships, intellectual assets, environmental stewardship, and human capital. The IIRC recognized that these factors significantly influence long-term organizational success and therefore developed a framework capable of communicating a more complete picture of value creation. Another important subtopic is framework development and revision. The January 2021 framework superseded the earlier December 2013 version and became applicable to reporting periods commencing on or after the 1st of January 2022. This revision reflects the ongoing evolution of reporting practices and the increasing importance of integrated thinking. The IIRC's work laid the foundation for a reporting model that links financial and non-financial performance, supports informed capital allocation, and enhances corporate accountability. Its legacy continues through the IFRS Foundation's stewardship of the framework and its integration into the future of global reporting. Slide 3. The long-term vision of integrated reporting. This slide presents the long-term vision of integrated reporting, which extends beyond reporting itself and seeks to transform how organizations think, govern, and create value. The vision is rooted in the concept of integrated thinking, which encourages organizations to understand the interconnectedness of their activities, resources, stakeholders, and long-term objectives. The primary topic is integrated thinking embedded in business practice. The framework envisions a future in which integrated thinking becomes a standard management practice across both public and private sectors. Rather than treating financial, sustainability, governance, and operational considerations separately, organizations would integrate them into strategic decision-making processes. A significant subtopic is integrated reporting as the corporate reporting norm. The framework anticipates a world where organizations communicate through a single connected narrative that explains how value is created, preserved, or eroded. Such reporting enhances transparency and supports better stakeholder understanding. Another important subtopic is efficient and productive capital allocation. Integrated reporting improves the quality of information available to providers of financial capital, thereby facilitating more effective investment decisions and resource allocation. Better information enables investors to assess organizational resilience, sustainability, and long-term value creation potential. The final subtopic is financial stability and sustainable development. The framework recognizes that efficient capital allocation contributes to economic stability and sustainable development outcomes. By promoting integrated thinking and connected reporting, organizations can support both corporate success and broader societal well-being. Slide 4. What integrated reporting aims to achieve? This slide explains the key objectives of integrated reporting and the benefits it seeks to deliver for organizations, investors, and society. The framework identifies 4 major aims that collectively support improved decision-making and sustainable value creation. The first principal topic is improving capital allocation. Integrated reporting enhances the quality of information available to providers of financial capital, enabling more efficient and productive allocation of resources. Investors increasingly require information beyond traditional financial metrics to assess long-term value creation potential. The second principal topic is cohesive reporting. The framework promotes a more connected approach to corporate reporting by integrating information from various reporting streams. This helps stakeholders understand the full range of factors affecting organizational performance and value creation. The third principal topic is enhanced accountability and stewardship. Organizations are encouraged to take responsibility for the broad range of capitals they use in effect, including financial, manufactured, intellectual, human, social and relationship, and natural capital. Understanding the interdependencies among these capitals supports more responsible management practices. The fourth principal topic is support for integrated thinking. Integrated reporting promotes decision-making and actions that focus on creating value over the short, medium, and long term. It encourages organizations to consider how strategic choices affect multiple capitals and stakeholder groups. Collectively, these objectives position integrated reporting as a strategic tool for transparency, accountability, sustainability, and long-term value creation. Slide 5. Integrated reporting as the corporate norm. This slide explores the concept of integrated reporting as the corporate reporting norm, highlighting its role in shaping the future of corporate disclosure. The framework views integrated reporting as part of an evolving reporting ecosystem that supports transparency, accountability, and value creation. The primary topic is global reporting evolution. Across many jurisdictions, organizations are adopting broader disclosure practices that incorporate environmental, social, governance, and strategic information. Integrated reporting aligns with these developments by providing principles-based guidance for preparing connected and value-focused reports. A significant subtopic is acceleration of reporting innovation. The framework aims to encourage innovation by providing organizations with a flexible structure for communicating value creation. Rather than prescribing detailed reporting requirements, it promotes principles that can be adapted to different contexts and industries. Another important subtopic is from fragmented to connected reporting. Historically, organizations produced multiple disconnected reports addressing different stakeholder needs. Integrated reporting seeks to replace these fragmented communications with a coherent narrative that demonstrates connectivity among strategy, governance, performance, risks, and opportunities. The final subtopic is integrated thinking and assurance. The framework emphasizes that integrated reporting should be supported by integrated thinking, appropriate regulation, comprehensive reporting frameworks, and effective assurance mechanisms. These elements collectively strengthen confidence in reported information. As reporting practices continue to evolve, integrated reporting is expected to become a widely accepted standard for communicating sustainable value creation. Slide 6. Integrated thinking, the foundation. Integrated thinking forms the cornerstone of the International Integrated Reporting Framework and represents a management philosophy that promotes a holistic understanding of how an organization creates, preserves, and sustains value over time. It involves the active consideration of relationships and interdependencies among an organization's operating units, functional departments, stakeholders, resources, and strategic objectives. Rather than viewing business functions in isolation, integrated thinking encourages leaders to recognize the interconnected nature of decision-making and its implications for long-term organizational success. A central element of integrated thinking is the effective management of various forms of capital that an organization uses and affects. These capitals include financial, manufactured, intellectual, human, social and relationship, and natural capital. Organizational activities continuously influence these capitals through increases, decreases, or transformations, making it essential for management to understand the trade-offs and synergies among them. Sustainable value creation occurs when these capitals are managed in a balanced and responsible manner. Integrated thinking also strengthens an organization's capacity to respond to changing stakeholder expectations, emerging risks, and evolving market conditions. By considering both internal capabilities and external influences, organizations become more agile, resilient, and capable of adapting their business models to dynamic economic, social, environmental, and regulatory environments. From a strategic perspective, integrated thinking helps organizations align their business strategies with long-term objectives while addressing risks and opportunities. It encourages management to evaluate how strategic decisions impact multiple capitals and stakeholder groups simultaneously. Furthermore, integrated thinking enhances the evaluation of organizational activities and performance. Performance is assessed not only through financial outcomes but also through broader impacts on people, relationships, innovation, and environmental resources. This comprehensive perspective enables organizations to make informed decisions, improve accountability, strengthen stakeholder trust, and create sustainable value for both the organization and society over the short, medium, and long term. Slide 7 is to 1a, Integrated Report defined. This slide introduces the formal definition of an integrated report, which forms the foundation of the International Integrated Reporting Framework. Understanding this definition is essential because it establishes the purpose, scope, and strategic importance of integrated reporting within modern corporate disclosure systems. The primary topic is integrated report defined. According to the framework, an integrated report is a concise communication that explains how an organization's strategy, governance, performance, and prospects, within the context of its external environment, contribute to the creation, preservation, or erosion of value over the short, medium, and long term. A significant subtopic is concise communication. The framework emphasizes that integrated reporting should communicate essential information clearly and efficiently. It is not intended to be an exhaustive repository of all organizational data but rather a focused narrative highlighting the factors that materially influence value creation. Another important subtopic is strategic connectivity. The integrated report connects governance, strategy, operational performance, risks, opportunities, and future outlook into a coherent narrative. This helps stakeholders understand how organizational decisions influence future performance and sustainability. A further subtopic is value creation over time. Integrated reporting recognizes that value creation is dynamic and occurs across multiple time horizons. Consequently, organizations must explain not only current performance but also their ability to sustain value in the future. Finally, the framework specifies that an integrated report should be prepared in accordance with the requirements of the framework, thereby ensuring consistency, credibility, and comparability among reporting organizations. Slide 8 is to 1b, Objective of the framework. This slide focuses on the objective of the framework, which establishes the purpose and intended application of the International Integrated Reporting Framework. The objective provides the conceptual foundation that guides the preparation and presentation of integrated reports. The principal topic is establishing guiding principles and content elements. The framework is designed to define the principles and content requirements that govern integrated reporting while explaining the fundamental concepts that underpin them. These principles help ensure that integrated reports remain relevant, connected, and focused on value creation. A key subtopic is scope of application. Although the framework was developed primarily for private sector, for-profit organizations, it can also be adapted by public sector entities and not-for-profit organizations. This broad applicability reflects the universal relevance of value creation and accountability. Another important subtopic is assessing the ability to create value. The framework identifies information that should be included in an integrated report to assist users in assessing an organization's capacity to create value. However, it does not prescribe performance benchmarks or evaluate the quality of organizational strategies. A further subtopic is broad interpretation of value creation. The framework explicitly recognizes that value may be created, preserved, or eroded. This broader perspective ensures that organizations communicate both positive and negative impacts on value over time. Through these objectives, the framework promotes transparency, accountability, and a more comprehensive understanding of organizational performance and sustainability. Slide 9 is to 1C, Purpose and Users of an Integrated Report. This slide explains the purpose and users of an integrated report, clarifying who benefits from integrated reporting and why the information is important. Understanding the intended audience helps organizations prepare reports that meet stakeholder information needs effectively. The primary topic is the primary purpose of an integrated report. The framework states that the main purpose is to explain to providers of financial capital how an organization creates, preserves, or erodes value over time. This objective requires the inclusion of both financial and non-financial information relevant to value creation. A key subtopic is providers of financial capital. Investors, lenders, and other capital providers require a comprehensive understanding of organizational strategy, governance, risks, opportunities, performance, and future prospects. Integrated reporting helps them make informed investment and resource allocation decisions. Another important subtopic is broader stakeholder benefits. Although financial capital providers are the primary audience, integrated reports also provide valuable insights to a wide range of stakeholders. These include employees, customers, suppliers, business partners, local communities, legislators, regulators, and policymakers. A further subtopic is long-term value perspective. Stakeholders are increasingly interested in how organizations create sustainable value over time rather than focusing solely on short-term financial performance. Integrated reporting addresses this need by providing a broader perspective on organizational resilience and sustainability. Ultimately, integrated reports enhance stakeholder understanding, support accountability, and strengthen trust by communicating how organizations create value for both investors and society. Slide 10 is to 1D, a principles-based approach. This slide discusses the principles-based approach, one of the distinguishing features of the International Integrated Reporting Framework. Rather than imposing rigid reporting requirements, the framework provides principles that organizations can apply according to their unique circumstances. The primary topic is balance between flexibility and prescription. The framework seeks to accommodate the diversity of organizations while maintaining sufficient comparability across reporting entities. This balance enables organizations to communicate value creation effectively without being constrained by overly prescriptive requirements. A significant subtopic is materiality and professional judgment. The framework does not prescribe specific performance indicators, measurement methodologies, or disclosure topics. Instead, report preparers must exercise professional judgment to determine which matters are material and how they should be disclosed. Another important subtopic is quantitative and qualitative information. Quantitative indicators such as KPIs and monetized metrics can provide valuable insights. However, the framework recognizes that value creation is best communicated through a combination of quantitative and qualitative information. A further subtopic is value beyond monetary measurement. The framework explicitly states that the purpose of an integrated report is not to quantify or monetize the total value of an organization at a specific point in time. Instead, it seeks to explain the processes and factors that influence value creation. This principles-based approach enhances relevance, flexibility, transparency, and organizational accountability. Slide 11 is to 1E, form of report and relationship with other information. This slide examines the form of report and relationship with other information, explaining how integrated reports should be presented and how they relate to existing corporate disclosures. The first principal topic is designated and identifiable communication. An integrated report should be a clearly identifiable communication that stands on its own as a meaningful explanation of value creation. It should be more than a summary of information contained in other reports. A key subtopic is connectivity of information. The integrated report should explicitly demonstrate connections among strategy, governance, performance, risks, opportunities, and the capitals. This connectivity distinguishes integrated reporting from traditional reporting approaches. The second principal topic is compliance and reporting options. Organizations may prepare integrated reports to satisfy existing regulatory requirements. The report may be presented as a standalone publication or as a prominent section within another report, such as an annual report containing financial statements. Another important subtopic is entry point to detailed information. The integrated report may direct readers to additional information located elsewhere. For paper-based reports, this may involve appendices. For digital reports, hyperlinks may be used to connect users to more detailed disclosures. This approach supports concise reporting while ensuring stakeholders have access to comprehensive information when required. Slide 12 is to 1F, application of the framework. This slide focuses on the application of the framework, outlining the requirements organizations must satisfy when claiming compliance with the International Integrated Reporting Framework. The principal topic is compliance with framework requirements. Any communication that claims to be an integrated report and references the framework must apply all mandatory requirements identified in bold italic type. These requirements ensure consistency and integrity across integrated reporting practices. A key subtopic is permitted exceptions. The framework recognizes that organizations may occasionally be unable to disclose material information due to legal restrictions, unavailable reliable data, or concerns regarding significant competitive harm. In such circumstances, exceptions are permitted. Another important subtopic is disclosure of omitted information. When material information is omitted, organizations should clearly explain the nature of the omitted information, the reasons for omission, and any steps being taken to obtain the information in the future. A further subtopic is role of guidance material. The framework distinguishes between mandatory requirements and supporting guidance. Guidance assists organizations in applying the requirements but does not need to be fully reproduced within the integrated report. These provisions help ensure transparency, accountability, and practicality while maintaining the credibility and usefulness of integrated reports. Slide 13 is to 1G, responsibility for an integrated report. This slide focuses on responsibility for an integrated report, an essential governance requirement within the International Integrated Reporting Framework. The credibility and reliability of an integrated report depend significantly on the commitment and accountability of those charged with governance. The primary topic is governance responsibility and accountability. The framework requires an integrated report to include a statement from those charged with governance acknowledging their responsibility for ensuring the integrity of the report. This statement demonstrates leadership commitment to transparency, accountability, and effective corporate stewardship. A significant subtopic is opinion on framework compliance. The governance statement should include an opinion or conclusion regarding whether, and to what extent, the integrated report has been prepared in accordance with the framework. This enhances stakeholder confidence in the quality and reliability of reported information. Another important subtopic is consideration of governance structures. The framework recognizes that governance structures vary according to jurisdiction, legal requirements, ownership characteristics, organizational size, and cultural context. Consequently, the application of governance responsibility should be adapted appropriately. A further subtopic is process transparency. Where legal or regulatory requirements prevent a formal governance statement, organizations are encouraged to disclose the processes, systems, controls, committees, and governance arrangements used to prepare the report. Such disclosures provide assurance regarding report integrity and oversight. Ultimately, governance responsibility strengthens trust, enhances accountability, and reinforces the strategic importance of integrated reporting within organizational decision-making and stakeholder communication. Slide 14 is to 2A, Introduction to Fundamental Concepts. This slide introduces the fundamental concepts that underpin the International Integrated Reporting Framework. These concepts provide the theoretical foundation for understanding how organizations create, preserve, or erode value over time. The primary topic is value creation as a multidimensional process. The framework emphasizes that value is not created solely within the boundaries of an organization. Instead, value creation results from the interaction between the organization, its stakeholders, the external environment, and various forms of capital. A significant subtopic is influence of the external environment. Economic conditions, technological advancements, societal expectations, regulatory developments, and environmental challenges all influence the organization's ability to create value. These external factors shape opportunities, risks, and strategic choices. Another important subtopic is relationships as drivers of value creation. Stakeholder relationships play a critical role in organizational success. Customers, suppliers, employees, regulators, communities, and investors all contribute to value creation through their interactions with the organization. A further subtopic is dependence on multiple capitals. Organizations rely upon various forms of capital, including financial, manufactured, intellectual, human, social and relationship, and natural capital, as inputs to their activities. Effective management of these capitals supports sustainable value creation. The framework therefore aims to provide insight into how organizations interact with their external environment, relationships, and capitals to create, preserve, or erode value over different time horizons. Slide 15 is to 2B, Value Creation, Preservation or Erosion. This slide examines the concept of value creation, preservation or erosion, which lies at the heart of the integrated reporting framework. The framework recognizes that organizational activities can generate positive, neutral, or negative effects on value over time. The primary topic is changes in capitals as indicators of value. Value manifests itself through increases, decreases, or transformations in the capitals resulting from organizational activities and outputs. Consequently, value creation should be evaluated through a broad perspective that extends beyond financial performance alone. A significant subtopic is value for the organization. Value creation for the organization affects financial returns available to providers of financial capital. Effective management, innovation, stakeholder engagement, and operational excellence contribute to enhanced organizational value and long-term competitiveness. Another important subtopic is value for others. Organizations also create value for stakeholders and society through employment generation, customer satisfaction, environmental stewardship, community development, and responsible business practices. Providers of financial capital are interested in both dimensions of value creation because they influence long-term sustainability. A further subtopic is interdependence between organizational and societal value. The framework emphasizes that an organization's ability to create value for itself is linked to the value it creates for others. Customer loyalty, supplier relationships, organizational reputation, stakeholder trust, and social license to operate all contribute to sustainable value creation. This broader understanding of value supports integrated thinking and long-term strategic decision-making. Slide 16, Externalities and Multi-Capital Value. This slide explores two important concepts within integrated reporting: externalities and multi-capital value creation. These concepts reinforce the framework's emphasis on understanding organizational impacts beyond traditional financial performance measures. The primary topic is externalities. Externalities are consequences of organizational activities that affect stakeholders, society, or the environment. They may be positive or negative and can result in increases or decreases in the value embodied within the capitals. A significant subtopic is material externalities and investor decision-making. Externalities often influence an organization's future performance and therefore affect the interests of providers of financial capital. Investors require information regarding material externalities to assess risks, opportunities, and long-term value creation potential. The second principal topic is multi-capital balance. The framework emphasizes that value creation rarely occurs through the maximization of a single capital. Sustainable success requires balancing multiple forms of capital simultaneously. An important subtopic is avoiding capital trade-off imbalances. For example, maximizing short-term financial capital by neglecting human capital through poor workforce practices may undermine long-term organizational performance and value creation. Effective organizations manage trade-offs responsibly and consider long-term consequences. This multi-capital perspective encourages organizations to evaluate decisions holistically and supports a more sustainable approach to corporate strategy, governance, and reporting. Slide 17 is to 2C, the capitals, stock and flow. This slide introduces the concept of the capitals, stock and flow, a fundamental element of the framework's value creation model. Capitals represent the resources and relationships that organizations depend upon and affect through their activities. The primary topic is capitals as stocks of value. The framework identifies 6 categories of capital that collectively support organizational success. These capitals are not static assets but dynamic stocks of value that continuously change over time. A significant subtopic is flow and transformation of capitals. Organizational activities frequently transform one capital into another. For example, investments in employee training reduce financial capital while increasing human capital. This transformation demonstrates how value moves between different capitals. Another important subtopic is complex capital interactions. Many organizational activities involve simultaneous increases, decreases, and transformations across multiple capitals. Investments in innovation may affect financial, intellectual, human, and social capital simultaneously. A further subtopic is potential value erosion. While organizations generally aim to create net value, some activities may erode value stored within specific capitals. Whether the overall outcome represents value creation or erosion often depends on the perspective adopted and the balance among capitals. Understanding stock and flow dynamics helps organizations communicate how their activities influence long-term value creation and sustainability. Slide 18, the 6 capitals, categories and descriptions. This slide presents the first 3 categories of the 6 capitals that underpin value creation within the integrated reporting framework. These capitals represent critical resources used by organizations to generate sustainable value. The first principal topic is financial capital. Financial capital refers to the pool of funds available for organizational activities, including debt financing, equity investments, grants, retained earnings, and operational cash flows. Financial capital supports investments, growth, innovation, and operational continuity. The second principal topic is manufactured capital. Manufactured capital includes physical assets used in production and service delivery, such as buildings, machinery, equipment, infrastructure, transportation networks, waste treatment facilities, and utilities. These assets support operational efficiency and organizational productivity. The third principal topic is intellectual capital. Intellectual capital comprises organizational knowledge-based assets, including patents, copyrights, software, proprietary systems, procedures, protocols, licenses, and tacit organizational knowledge. Intellectual capital often serves as a key source of innovation and competitive advantage. An important subtopic is strategic importance of capitals. These capitals interact continuously and collectively contribute to value creation. Effective management of financial, manufactured, and intellectual capital strengthens organizational resilience, competitiveness, and long-term sustainability. Together, these capitals provide the foundation for understanding how organizations generate and sustain value across different time horizons and stakeholder groups. Slide 19. The six capitals, continued. This slide continues the discussion of the six capitals, focusing on human capital, social and relationship capital, and natural capital. These capitals are increasingly recognized as critical drivers of sustainable value creation and long-term organizational success. The first principal topic is human capital. Human capital encompasses the competencies, capabilities, experience, knowledge, and motivations of employees. It includes their ability to innovate, align with governance frameworks, implement organizational strategy, and continuously improve products, services, and operational processes. Organizations that invest in employee development, leadership capability, training, and engagement strengthen their capacity for long-term value creation. The second principal topic is social and relationship capital. This capital reflects the relationships, networks, institutions, trust, shared values, and social structures that support organizational operations. It includes stakeholder relationships, brand reputation, community trust, social license to operate, and collaborative partnerships. Strong social and relationship capital enhances resilience, stakeholder confidence, and long-term sustainability. The third principal topic is natural capital. Natural capital includes all renewable and non-renewable environmental resources and ecological systems that support organizational prosperity. Examples include air, water, land, minerals, forests, biodiversity, and ecosystem health. As environmental risks and resource constraints increase globally, effective stewardship of natural capital has become a strategic imperative for organizations. An important subtopic is material relevance of capitals. The framework acknowledges that not all capitals are equally significant for every organization. Materiality determines which capitals warrant detailed disclosure within an integrated report. Slide 20. Role of the capitals in the framework. This slide explains the role of the capitals in the framework, clarifying why the concept of capitals is included and how organizations should use the capital model when preparing integrated reports. The primary topic is capitals as a foundation for value creation. The framework incorporates the capitals because they provide a theoretical basis for understanding how organizations create, preserve, or erode value. The capitals help organizations identify the resources and relationships they depend upon and affect through their activities. A significant subtopic is guidance rather than prescription. The framework does not require organizations to structure reports around the six capitals or use the exact categories specified. Instead, the capitals serve as a guideline to ensure comprehensive consideration of all significant value drivers. Another important subtopic is flexible categorization. Organizations may define and categorize capitals differently according to their specific circumstances. For example, stakeholder relationships and brand reputation may be treated as separate capitals, integrated within existing categories, or considered cross-cutting themes. Similarly, intellectual capital may be subdivided into human, structural, and relational components. A further subtopic is avoiding capital oversight. Regardless of how organizations categorize capitals internally, the framework encourages use of the six capital model as a reference point to avoid overlooking important resources, relationships, dependencies, and impacts. This flexibility allows organizations to apply integrated reporting principles while maintaining relevance to their unique business models and strategic contexts. Slide 21 is to 2D, the value creation process. This slide presents the value creation process, one of the most important visual representations within the International Integrated Reporting Framework. The diagram illustrates how organizations transform inputs into outputs and outcomes while interacting continuously with the external environment and multiple capitals. The primary topic is value creation as an integrated system. The framework views value creation as a dynamic and iterative process rather than a linear sequence of activities. Organizations continuously interact with stakeholders, capitals, risks, opportunities, governance structures, and strategic priorities. A significant subtopic is external environment and governance. The external environment provides the context within which organizations operate, while governance establishes oversight mechanisms that support strategic direction, accountability, and sustainable value creation. Another important subtopic is the business model. At the center of the value creation process, the business model draws upon various capitals as inputs. Through business activities, these inputs are transformed into outputs such as products and services and into outcomes that affect stakeholders and capitals. A further subtopic is risks, opportunities, strategy, performance, and outlook. These interconnected elements continuously influence and refine organizational decision-making. Strategy and resource allocation respond to risks and opportunities, while performance measurement and outlook assessments support continuous improvement. The value creation process therefore illustrates how integrated thinking links governance, strategy, business operations, performance, and sustainability into a unified system focused on long-term value creation. Slide 22. Components of the value creation process. This final slide examines the components of the value creation process, providing a structured explanation of the major elements that collectively drive organizational value creation. These components illustrate how organizations create, preserve, or erode value through an ongoing cycle of planning, execution, monitoring, and adaptation. The first principal topic is external environment. Economic conditions, technological developments, societal expectations, environmental challenges, and regulatory factors establish the context within which organizations operate. Organizational purpose, mission, and vision guide responses to these external influences. The second principal topic is governance. Governance structures provide oversight and accountability, ensuring that strategic decisions support sustainable value creation. Those charged with governance play a critical role in establishing effective controls, ethical standards, and strategic direction. The third principal topic is the business model. The business model represents the operational core of the organization. It utilizes capitals as inputs, transforms them through business activities, produces outputs such as products and services, and generates outcomes affecting stakeholders and capitals. The fourth principal topic is strategy and outlook. Organizations continuously monitor risks and opportunities, develop strategies to address them, allocate resources effectively, and evaluate performance outcomes. This ongoing review process drives continuous refinement and improvement across all organizational activities. Together, these components form a comprehensive framework for understanding how organizations create sustainable value, manage uncertainty, allocate resources, and strengthen resilience in an increasingly complex business environment. Here we end this presentation and now shall move to part 2 of the Integrated Reporting, International Framework. We encourage you to remain actively engaged with our channel, participate in the forthcoming sessions in continuing this topic related to various types of risk associated in sustainable disclosures, and thoughtfully disseminate these professional insights across your networks, particularly among business leaders, sustainability practitioners, compliance professionals, and stakeholders committed to advancing responsible corporate governance and transparent reporting practices.